Hello everyone. Back in November last year, I did a little talk on Portfolio Matters about ideas for possible inflation hedge investments. That was in the context of very low fixed income rates and very low negative real yields on inflation bonds. During that presentation, I covered 4 different areas: infrastructure trusts, green energy trusts, social housing and selected REITs. And in that presentation I came to the conclusion that they were a reasonably attractive proposition, for me at least, in that they offered about 4 to 6% income yield, and there was a reasonable prospect of something like inflation rates of growth in the dividends and possibly the asset values of those trusts. Now, given everything that's happened in the market in terms of share prices, but also what's happened in the economy in terms of rampant inflation, I thought I'd give a quick update on some of the impacts on the trusts that I was reviewing, because I think there's a couple of very interesting events which have highlighted the attractions of this area. So turning first to the green energy trusts. Now, these are things like solar and wind farms. They're actually pretty simple businesses where the revenues come from government green subsidies. That represents about 60% of the income of the various trusts. And crucially, those subsidies have an RPI escalation built into the contracts. RPI, of course, being more attractive than CPI, because RPI tends to run about 1% ahead of CPI. The other 40% of the revenues from these green trusts comes from the actual sale of electricity. So that if that's the revenue side, the cost side is actually dead simple. After the initial setup of the wind farm or the solar panel farm, there are some ongoing maintenance costs, but it's pretty low and pretty predictable. The other thing about these green energy trusts is that they had a reasonable level of gearing, about 40% of gross asset value. So that was the situation back in November, but there's been some quite interesting developments in the green energy or renewable trust area, primarily as the result of impacts on the revenue streams. So what's happened is really both of those streams of revenues, the subsidies and the electricity price, have been hugely beneficial to these trusts. So the subsidies are called renewable obligation certificates, and as I mentioned, they've got RPI indexation built into them. Now, this has meant that there's been about a 5% increase in the net asset value estimates for these green energy trusts, simply from the straightforward impact of the RPI indexation feeding through to the value of these renewable obligation certificates. Now, for most of the green energy trusts that have reported in the first quarter, all they're doing is reflecting this year's increase in inflation before they're fading back their inflation assumption for future years. So if inflation's coming in at 8 and they were previously assuming 3, well, that's a 5% uplift beyond what their previous modelling was suggesting. But typically the trusts are not increasing their long-term inflation assumption. So if in future years there's a similar outperformance of inflation compared to the model's assumptions, there will be further increases in the NAV estimates, reflecting that persistent inflation. So that's about 60% of their revenue directly benefiting from the RPI indexation. The other 40% of their revenues come from the electricity price, and as we all know, that's been very high, very strong, based on the shortage of gas impacted by Putin's war. That has fed through directly to the electricity price. Now, the different trusts have different hedging strategies when it comes to the electricity market. So it's a bit like the oil market. Some companies have hedged their sales out 1 year, 2 year, sometimes even 3 years. Others are selling into the spot market. So you need to do your research to see the differences between the different trusts and how they've hedged their future electricity sales. But roughly, there's been about a 5% or higher increase in the NAVs across the board of these renewable energy trusts, directly benefiting from the high electricity price. So a 5% increase from the RPI indexation of the renewable certificates, 5% increase from the direct read across from the electricity price is leading to some pretty chunky increases in the net asset values across the renewable energy space. That, of course, is in the context of a relatively low-risk bet. I show here a chart of the increase in the NAV for one of the leading renewable energy trusts, that is Greencoat. So a 10% increase is way beyond what I was assuming that these trusts could produce, and is a direct result of high inflation and high commodity prices. Now, previously, there had been some concern that these renewable energy trusts were going to cannibalise each other, and that dividends were not going to be able to increase in line with inflation, but those fears have evaporated now as the high revenues come through from both those sources. So a pretty encouraging picture across the renewable energy trusts. They're benefiting directly from inflation. Turning to another area that I highlighted previously, real estate investment trusts. I think there's also an impact of inflation here, but what I want to do is look at the impact of debt when we examine some of the real estate investment trusts. So these are things like warehouses, student accommodation, or social housing. Now, many of them have RPI or CPI linked contracts, a bit like the renewable obligation certificates I was talking about in terms of the green energy trusts. Now, some real estate investment trusts criticise these inflation-linked contracts on the basis that they're becoming financial instruments and not real assets, and there might be some drift between the open market value of the assets and the value given to them by looking at them as simply index-linked proxies. So there is an issue to think about there. It's a risk I'm pretty happy to take, but it's something to be aware of. But the main point that I want to look at in terms of the real estate investment trusts is the impact of gearing, because a lot of these trusts have about 40% gearing. Now, normally I think of myself as a pretty prudent investor, and so I'm normally rather leery of high amounts of debt. But I have to say I'm beginning to reconsider that view in the context of the current market environment for inflation and debt costs. So obviously, as we all know, debt has been very cheap. Debt for many of these real estate investment trusts is fixed, and it's long-term debt. And that makes, I think, a pretty big difference to the earnings and dividend outlook for the REITs. So I'm just going to walk through a little stylized example here. So if we imagine a real estate investment trust with assets valued at 1,000, that being represented by 400 of debt and net assets of 600, a typical net investment yield on that might be about 5%, which therefore produces 5% of 1,000 would produce revenue of 50, from which I'm going to take away costs and fees of about 25% of the revenues. So that'll be about 12.5. Interest at 2% would take away another 8, leaving earnings of about 30. So that's the steady state example. Now, if we just, for the sake of argument, assume that there's going to be 5 years of 5% inflation, and we look at the position after that, now things here I think get quite interesting. If we assume, which I think is probably very conservative, that the asset value remains at 1,000, the debt remains at 400, and the net assets at 600, If we look then at what has happened to the income side, well, the rents have grown in line with RPI or CPI, whatever the contract says. So if we're assuming that at 5%, the net investment yield has gone from 5% to 6.4%. So revenue has gone from 50 to 64%. So that's up by about 28%, i.e. 5% compounded over 5 years. So revenue has gone from 50 to 64. I'll still assume that the costs and fees are 25% of revenues, so that now takes away about 16. But crucially, the interest remains simply at 8 because it's a low rate and it's fixed and it's long term. So that means that earnings can go from about 30 to about 40. So although revenue has only gone up 28%, earnings can go up 35% because the rents have gone up with inflation, but the interest expense has remained the same in nominal terms. So you get debt gearing. Now this may be reasonably obvious, but I think working it through is a reassurance that the debt is actually working to shareholders' benefits. Now this was an assumption focused primarily on looking at earnings and dividend sustainability. But I think it's actually quite likely that over a period of extended inflation, that asset value, which I assumed in this example would just stay the same, is actually quite likely to float up over time. The other thing to say is that in the real world, there are actually caps and collars on the inflation indexation of the rents. Typically, it might be capped at 4% and collared at 1%. So the emphasis here, I think, is that the debt, the amount of debt in the company means that the dividend growth can be higher than the revenue growth. So even if the rents are capped at 4% per year, you could still get higher than that as earnings and dividend growth because the debt cost is going to remain the same in nominal terms. Now that was a stylized example. If we turn to some real life data to look at debt gearing, here's 3 possible real life examples. These are 3 that I'm interested in investing in. The first is Tritax Big Box, the largest UK warehouse provider. That's got about 24% loan to value. Its cost of debt is about 2.3%, and its debt is fixed with an average maturity of 6.5 years. Now that's a UK-focused warehouse REIT. Turning to Europe, there's Aberdeen Standard Euro Logistics, which is a bit more geared. It's about 32% loan to value, but its cost of debt is just 1.36%, and that's fixed on average for 5.5 years. Now it's a European exposed warehouse provider, but it doesn't have assets in the areas that you might think of would be at risk in a euro crisis, like Italy, Greece and Portugal. It's more exposed to the Netherlands, Germany, Portugal and Spain. Another one that I've looked at and that I hold is LXI REIT. That's 25% geared. Its cost of debt is 2.85%, which is a bit higher than Tritax Big Box, but it's got 12 years average maturity on its debt. So in my mental image, I've got revenues increasing by inflation or capped and collared at 1 to 4% a year. Revenues going up pretty steadily, but that debt remaining fixed in terms of the interest cost. So normally I'm pretty cautious about debt, but I think we might have an example where it's genuinely of benefit to investors. Now quickly turning to some other trusts that I covered in the November presentation and how they're impacted by inflation. Well, I also covered some infrastructure investment trusts. These are companies that own things like schools, prisons, roads, railways, etc. And they typically have contracts with local or central government to provide those facilities. Now, those also have a degree of inflation linking, such that the revenues will increase by about 70 to 90% of the inflation rate. So they have a similar exposure like the REITs and the green energy trusts, where their revenues will directly rise with the inflation-linked contract. I also covered social housing REITs. That is real estate investment providers that provide housing typically for people with special needs or homeless people. And again, those contracts are typically CPI linked, in effect government-backed revenues. It's a form of housing benefit in effect. Though again, there's the caps and the collars on those revenue contracts, typically minimum 1% per annum increase, maximum 4% per annum increase. But much like the other REITs, because they have fixed cost long-term debt, you can get a higher earnings and dividend growth than that cap because of the impact of the debt. Now turning to a couple of charts to see how what's been happening in the markets. Well, the first chart here is Tritax Big Box, stock code BBOX. This is one that I'm already invested in and thinking of buying some more, because the stock price has fallen from about £2.50 to £2. Now that's because Amazon's recent results showed a slowdown in their revenue growth. So there have been some fears that the move to online and the move to warehouses is suddenly going to slow. I think that's a bit overdone. It seems to me that we're still going to be moving online and people are still going to be needing warehouses. And that was an effect with Amazon, where they'd had such high growth 1 year ago that this year they were never going to be able to live up to that comparison. There's also, I think, some fears about the inflationary impact on Big Box's development program. I suspect that's a much more real risk. However, the development program represents about 10 to 15% of the NAV. So yes, it could be painful, but I don't think it changes the underlying story. So Big Box is now on about a 3.4% yield. It seems to me pretty likely that the dividends are going to be able to float up at least in line with inflation, and the NAV may well increase as their development projects move from being valued as developments to being valued as ongoing trading assets. So this sharp sell-off in Big Box now means that it's on a 10% discount to the estimated net asset value. To me, that looks pretty attractive. I'm going to be reviewing my holding and minded to increase it. The other trust that I've invested in to my loss so far is Civitas Social Housing. We can see in the share price chart here, it's fallen from a peak of about £1.20 to about 85p. Now that's of course just the share price. It has been paying its dividends all this time, so that the loss isn't quite as bad as that, but not a happy story. The stock has been weak because there's fears that the housing associations that provide the revenue to the social housing provider have signed contracts that financially stretch them too much. It's an interesting debate. There are some very good articles on CityWire reviewing the real underlying risks or not in this structure. It's a risk that I've been prepared to take. I think ultimately it's still the cheapest way of providing social housing. So I think these trusts are likely to rebound at some point. They've been through the mill on this a couple of times in the past. So Civitas Social Housing now yields 6.6% and has been paying the dividend and steadily increasing it. To me, that's pretty attractive. It's now on about a 20% discount to NAV, and the company has been buying back its shares. It doesn't believe that the regulatory risk is that large. So, in conclusion, the contractual inflation linkages in the green energy trusts, in the infrastructure trusts, and in social housing, etc., I think are really beginning to make their presence felt, and there's some pretty good hope that the earnings and dividends can flow through in an inflation-linked way. So I think a portfolio of these trusts can give some immediate income plus growth, and I've invested in a diverse portfolio across all those areas. There is, however, some risk of retrospective legislation, as I was just highlighting in Civitas Social Housing. The other key message from today's presentation is to have a think about debt gearing. Previously, I've been cautious about that. I've not really liked debt and its risks, but it's difficult not to find it attractive if you can borrow for 1.5–2% fixed for 5 to 10 years. In a context of resurgent inflation, I think that's pretty attractive. Of course, you have to accept that debt is ultimately a risk. If there was widespread economic distress and default, debt would become much more of a liability. But for the moment, it looks attractive to me. Finally, and as ever, please do your own research. I've highlighted some general points and principles about some of these trusts. There is quite a lot of individual variation you should make yourself aware of. Many thanks for listening. Cheers, everyone.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.